Probably I need to set someone as an admin or something to just have them do that. But I'm also looking at the, there we go. They are joining, I guess. Getting up there in numbers. All right, so we're not going to wait any longer. I'm pretty sure we're going to record this and post it somewhere so you can check back in. Later on, I'll also likely, wherever this gets hung, put in a, we'll throw this on a file somewhere on our website, and you'll be able to download my DCF Excel spreadsheet. But it doesn't matter. They're all out there. I didn't sit here and invent one from scratch. Of course, I went and found one online, put it on there, and then adjusted it for what I need, right? So never get crazy or anything like that. And we'll explain that. So in DCF, or discounted cash flow valuation, we will be doing Apple, and I'm Greg Krause, one of the instructors at Option Players. I am a professor and soon to be completely retired. All right. So here at Option Players, we're about to roll out a new website that our CEO has been excited about. And there's nothing different. We still offer a free month trial, so it don't cost anything to come in. To give, everybody else can give their spiel, but if you want me to give my spiel, I'm not going to be I'm not a salesman. It is just a group of individuals. Look at it like a fraternity or a club that you belong to that's trying to help each other out. You won't see any of that to the moon stuff, but you'll also find out very quick I'm the pessimist in the group always. So although I may be very optimistic about something, since everyone else is extremely optimistic, I just keep it real and just play the bad guy. All right. So don't think I'm always against you. It's just what I do to try to keep everybody in check. All right. So we'll kind of get that here in a second when we go over this evaluation on how many people assume Apple is going to grow a certain amount. Now, I can't say it won't, but I can show by the numbers it's absolutely not going to, or it's not expected to, by all the money. All right. So, and look, I even got a video. Forgot to put that video in there for you. All right, so for the disclaimer, this is a live session, is to provide introduction into asset valuation, focusing on discounted cash flow. No topics, tools, or opinions are investment advice, and for educational purposes only. I'm not really going to be talking about making trades in this, more as in how you can use this to evaluate a stock in your own right. I am a technical analysis trader. Okay, that's what I do. All right. Now, I don't look at fundamentals and technical analysis as different. All right. I have professors that work with me, and they think, fundamentals is the only way. And then I get into the argument is, what are fundamentals? Can you explain what a fundamental is? And this is where they're going to straight go to. They're going to go to discounted cash flow. Well, the problem is discounted cash flow, you have to make assumptions, a lot of assumptions actually. And then most likely that's going to be based upon past performance or trends. You just said your whole fundamental system is based on what? Historical past events, trends. That's technical analysis. It's just I have a line or I have a bunch of little math algos that do it for me, and you're using some cash flow, or whatever evaluation system you're using. It's all technical analysis. All we can do is look at past and estimate the future to the best of our ability. If any of us were correct, even, I don't care who you are, if you were correct 80% of the time and you had the cojones to put all your money into it, every trade, you'd be a trillionaire, like in a year, right? That's, just compounding interest. So we all lose, or we at least are smart enough not to trade all of our money, and we trade small portions. So just just remember that. Now, we're going to go into first the concerns. As you said, I'm always the pessimist, so I want you to understand the limitations of anything that I go over. So in the discounted cash flow valuation or model, first off, it's ever changing. And the reason is tax rates change, interest rates change, and that changes everything about the discount, right? Or discounted cash flow, but a lot of it discount because that's interest rate. Now, one huge disadvantage is the terminal value. And if you don't understand what terminal value is say we are estimating 10 years of cash flow, okay, growth and everything else. Well, after that, we have to apply a terminal value. If you've ever done cash flow, it'd be like your Gordon growth model. If that's for a dividend stock, it's going to grow at this amount for the rest of the time. All right. Now, what is that number? Nobody can guarantee it. We will come up with an assumption in here, and we'll place that in there. But it has a extremely high effect on the outcome of the DCF, or the present value of the DCF. All right. It really works best, as you can see, when you know most likely what the cash flows will be. That means doing this on a company that's new, let's just say Tesla a few years ago, would most likely not be the best thing, right? Just would not be. Now, would it be the best thing to do on Apple? Probably. Apple has been around for a while. Okay.
Recording in progress.
But you never know what's going to happen, right? So with Apple, it's a pretty stable company, by far probably one of the most stable companies. And it also works really good when there's not a extremely high dividend. Now, or to put that in another words, it's not giving all of its money, all of its income away in dividends, right? It's holding some of that and investing it back into the company at least. Now, Apple does have a dividend, and it also has another thing that I like to look at as a dividend is just the cash buybacks. And it is a lot, especially right now. I mean, we'll talk about that later. But it's really very small in the amount of what Apple could do. You get what I'm saying? Apple could provide way more than a 1% dividend or a 2% dividend. They can really throw it out there if they wanted to. So since that's a lower case, we think it's going to stay a stable dividend and growth. Then we don't touch that because it's not going to affect the free cash flow of the company. Now, if it was one that fluctuated a lot, then we would have to look at it. All right. So REITs and things like that are normally not great. And it's extremely sensitive to two things: the growth, the assumption, perpetual growth rate, and the discount rate. And we will discuss the discount rate most of the time. Okay, so you're going to hate the discount rate. If you don't understand what a discount rate is, if you ever take finance, discount rate means 55 different things, okay? And what I mean by that is a discount rate could be the weighted average cost of capital. It could be the required rate of return. It could be an interest rate. It could be just what you want to make it. It's so crazy amount of stuff that we are going to focus on the two major ones, Kappa and WAC. And that's about it. So let's go to the next one, next slide here, and then we'll start talking to some people. So finding data, all right? So in here somewhere I have a nice little, did I skip it? I guess I did. Let me open up my PowerPoint real quick and see what happened to my, we got rid of it. All right, so everyone, I'll just spit it out now, okay? Everyone's heard of a bird in the hand is worth two in the bush, right? Everybody's heard that? Y'all can talk? What exactly does that mean?
And stack your gains.
Well, we can say something like that, but in a way it means I have one bird now, right? It's my in the actual, I guess, that metaphor means you got a bird now, keep that bird, don't go after the two in the bush. Well, that's completely the wrong answer, right? We have to find out whether or not getting up this bird is good if I can get those two in the bush. And that is basically what discount cash flow is going to tell you. How much is this one bird, right? I got this one bird. If I caught one bird from around that bush, how many more birds are going to be in that bush? Now, there's a great quote that Warren Buffett spit out about this, talking about the guy that came up with the quote and went over and then goes over everything. Well, there's really three questions you got to ask yourself about that bush or a company. Is what is the risk-free rate? That's not really about the company, but we got to know that, okay? How many birds are in that bush, or do we understand the cash flow? Okay. And what is that market risk premium? So how does it relate to the market? Okay. And we're looking at it. When I say a market, I'm talking about a market portfolio. Normally that's going to be the S&P 500. Okay. But you could do it to an industry or something like that if you wanted to. But when we say market risk premium, the gold standard is to use the S&P 500. And for risk-free rate, we'll go into that here in a second. So first thing you got to do is find data. All right. Now, it can be automated with financial data and APIs. Okay. I use a little financial modeling prep that I used a long time ago in school. And it's very easy for me to pull that API in and put it into Excel, and it does all my work for me. That's fine. But to be honest, I don't really mess with that too much. I can easily type in the numbers and just the cash flow, and I can leave a lot of the stuff that's going to be on this spreadsheet out. But you know, it helps you it can remind you of that also. Now, the next thing is SEC.gov. All right, and the main reason is that's where you can get all the filings. Now, to go there, some people go there and it's a little crazy, all right, and they don't really understand how to find it. So what I'm going to do here is pull up my thing and type in sec.gov. I'll do it off screen just in case some craziness shows up in my past history. You know what I'm talking about. All right. So, and where you want to go, instead of just start searching here, just go to more search options. And then go down to ticker and then hit Apple. It's already in there for you. All right. And then just go to find companies. All right. Now, you have an option to choose either 10Ks, which are your annual reports, or 10Qs, which are your quarterly, to get all this information. You're talking about going 10 years into the future, maybe even 5, maybe longer, to make estimates. So using quarters are kind of pointless. You want to just look at the 10 years. Now, for instance, Apple's going to have an extremely good year this year, I think. So it's probably going to be way more than what we give it, right? But we can adjust that based upon everything in the growth. So it's not something we have to do right there. But also with that growth, they did spend a lot more money, all right? So just go down until you see the last 10K, all right? And there you go. You don't really want interactives. You usually want to hit documents, all right? Right there. Tells you the date that it was issued. All right. Then the three things you're really looking for on here, okay, we're going to scroll down. Financial statements and supplemental data. That's what we want. All right. Now, consolidated statements of operations are going to talk about products, services, net sales, cost of sales, and all that good stuff. I'm going to figure out a lot of this information on my own and not even use it, but I will use, of course, net sales and things like that. Now, you also need income statements because we need to know all that about the income, realized gains, everything else, which we are normally going to get out of the balance sheet rather than that. So we're going to pull out the income statement, we're going to pull out the balance sheet, and then we're going to go find the cash flow. or the statement of cash flows. All right, and we're basically looking for all this information right here. And we're going to go way further back than that, right? But you're going to go down and you're going to have the share equity. Yeah, there it is. The consolidated, talking about that. We're going to skip all that. We know all that information because we're smart financial people and we understand. We know the debt, we know equity. So basically we know debt and we know the assets. So basically we take assets, subtract debt from that assets, and that gives us our equity because assets equals debt plus equity, always, or someone fib the books. All right, and then we want the consolidated statements of cash flows, all this information, which is going to give us a lot of stuff like net income, our depreciations, any taxes that were deferred or anything like that we can add into it, and much more stuff, but you don't really need it all because we're not going to go stupid in depth, because when you're talking about $7 million and your company is Apple, $7 million is like 1 cent. Okay, so we're not really going to worry about that one. Now, the next place, if you can't find it there, looking there, you'll see corporations, investor relations. Now, sometimes it's easier to read these, and what we're going to do is just type in Apple, and hopefully, I spelled Apple wrong, because don't go to a bad site. Don't go to a bad site. I keep spelling it wrong. All right. Thank you. It's sad, right? All right, so just usually go down to the end of whatever company you're looking for and just search around and you'll find something that says investors or investors relations. Click that. All right, pretty simple right here. Anything of those reports on any solid company is going to have it here. If they don't have a website, you can always request it also. So if you want to know anything about it, they'll have all their press releases here. You can go down, you can see all their 10Ks going back. Even if you want more, they'll give you more. All right. And if you want to know about their leadership or guidance or anything, it's all in here. Also, a great place to find out all about their financing and what their cost of capital is. But you can also find that out at the SEC website, actually. If you go right, instead of going there, there's a better way to get it, but back up one, go to like interactive data. Let's check that one out. Would it be in that one? Yeah, so it's talking about notes, when they're due, what the yield rate is on those notes. So you'll have to go through all these, type all these in, and so on and so on and so on. But look, they're going to report the weighted average cost of that. That's all you really need to know. Don't get crazy with it like that, right? Unless you're like trying to give them a loan, which if you're sitting here, you're probably not an investment banker throwing out money to Apple. All right, so it's pretty simple. Get the information and put it into Excel. Now, what will that look like? Pretty simple. Pre-done it because that would take us like 20 minutes to throw it in here. So I have an income statement, which is going over my net sales, which is products, services. You know, Apple doesn't split it apart, but you could if you wanted to. Cost of sales and all that good stuff. All right. Then the balance sheet, of course, is going to go over assets, debt, and liabilities, and and equity. That's basically what a balance sheet's going to do. And a statement of cash flow is exactly like it sounds. It's cash moving around. That's what we want to know, where that cash is going, right? So it's going to tell us all that good information in that statement of cash flows. You throw it in here, you're good to go. If you don't understand what that means with the parentheses around it, it means it's negative, all right? And then you're going to come out to this little standard DCF, all right? Anything that's in gray comes from the income statements or a formula in the income statements. Anything in the blue is, or over here, is up to us to change. I guess I kind of made those kind of close gray. It didn't look like that when I made it. And then anything that's white is a formula that is in this sheet. So you don't touch anything, but basically I'll make them all blue so it kind of looks a little better. Unless it's blue, all right? Those are the only ones you can adjust, and still be careful when you're adjusting them because it could still be a formula. So basically I'm taking this one and adding 0.5% to it each year. All right. So as I said, the discount rate affects it a lot, all right? Will affect the valuation of Apple a lot, and so will the terminal value. Now, I can't do much for the terminal value. I'll show you how to get it, of course, but because it's just math. But I do need to understand what a discount rate is, okay? So what data do you need? We already been over that. Understanding finance math. Now, I am not going to show you too many formulas. I think I only have 2, and we really don't care because I think at the end of it, I'm just going to tell you to Google it anyways. Or I don't like the Google word, but I'll give you a good website that you can go and get all this information. All right. Now, we cover a little, I guess, but you need to understand what's in this stuff. So you got to understand what gross profit is, earnings before taxes and interest and depreciation. Understand why cash flow is important. Everybody says cash is king. I don't care what your revenue is. I don't care how much you grew. You want to know what I really care about? I care about the cash you got, right? That's all I care about, right? That's it. That's all investors care about. If you got more cash, it's more money to put into the company or more money to give your investors. That's why we care about cash. All right. And cash flow, of course, is what you got left over. All right. And net present value. If y'all don't understand net present value, basically, if I give this bird up, I'm going to get 2 more in a year. Another way to look at it is if you ever, what's that one? I'm going to make one of y'all get online here and tell me. What's that commercial where you have like an annuity and they're like riding in the bus and they start singing? You know, like if you've got an annuity, call what?
J.G. Wentworth.
Yeah, that's right. All right. J.G. Wentworth, right? Whatever 1-800 number. It used to pop up all the time. So that's it. So say you're getting an annuity that is $500 every month for the rest of your life. Well, what are they going to give you for that annuity? Well, first, they've got a required rate of return. They're going to have some risk in there that they're going to take, okay? But really, when they're going to look at it and they're going to say, okay, I can get $500 for 30 years, right? Well, I have to make 10% on this. I also have to account for inflation and everything else. They're going to do that, I promise. And then they put all that money in and come back and give them the net present value of all that money that you got paid in the future. Well, I'm going to let you know it's going to be way less than what you were going to get, right? It just is. So that's the same way lotteries work and everything else, okay? Sometimes it's a lump sum. No, they're giving you the net present value of all that earnings. That's why it's so much less, right? But if you actually invested it, okay, and you didn't even touch it, it usually matches up pretty even with the risk-free rate. If you live to be, I forgot what every lottery uses a different one, but it's usually, I think, 40 years. So basically, if you made risk-free rate, it's 40 years in that advance on the average risk-free rate. All right, so let's hate this real quick. All right, so here we go, a little bit of math. I got people jumping in here. I'm sorry. I got to keep looking into this and knocking them out. So required rate of return, okay? And now I'm going to talk about this. That is your discount rate. That is what we're going to be looking at, all right? And so what is a required rate of return? Now, we can look at this a different way, but it's basically the minimum return that an investor, you, will accept for owning a company's stock or investing in something as compensation is given a level of risk associated with holding that stock, right? So what I mean is I want to make 10%, but then I need to add a little bit extra because of the risk. Now, the required rate of return is also used in corporate finance to analyze profitability of potential investment projects, like I also told you, right? And a lot of times, if you're in finance, you probably have a BA, a Texas Instrument BA 2+, or the HP one. I'm a Texas Instrument guy, and you probably live with the 5 keys, NPV button, and the IRR button. So, or just do what most of us do and use the Excel. But it's sad that I still say I usually have a financial calculator on me everywhere I go. All right, so now this is one, if you want to know, like Warren Buffett, right? So Warren Buffett refers to the required rate of return as the hurdle rate, the hurdle rate, which, and we're looking at it as a discount rate. So in his idea, it's the required rate of return that equates to the appropriate return necessary to take on associated risk from the company in question. That's it. Now, that's all good. And we're going to get into it later, but it's basically what you have to make or what you want to make on this. And normally what we look at is, I have this company over here, I know I can make 10% on. So and that has less risk, I need at least 13 from this company because it's a little bit more risky. Now, how do you determine risk? Volatility, probability. We're not getting into that here today. I can't teach you. Well, there is standard deviation today. I'm not going to teach you that, but I'm not going to go into variances and probability here. All right. Now, number 2, how do you calculate required rate of return? Well, there's multiple ways to calculate it because the rate of return means so much different stuff. Most companies will use a company, that means not an investor, will use the weighted average cost of capital, okay? And what I mean by that is if they're going to invest $100 million into something, right? How much profit is it going to get, right? If it brings in $110 million for them in 2 years, was it worth the investment? Probably not, because you just put $100 million into something and only got back 10% over 2 years. So, that's even less than 5% yield per year, right? Because of compounding, if you haven't figured it out. But, so that's not worth it. So the required rate of return on that would need to be, at first it has to take in the associated risks, but also, hey, I can make 7% right now doing this. All right, so it's a little different there. All right. So for us, we're going to look at that required rate of return. I like to say it because it's a lot easier to say RRR or type RRR than all the other stuff. But it's also discount rate, if you hear me say that. It is the minimum return that we'll accept to invest in that company. Simple. All right. Now, there are 2 main ways to calculate this, or formulas to calculate it. There's more, but we're just going to go on it. You have the capital asset pricing model, or CAPM, and you have the weighted average cost of capital, the WACC, not the WAP, the WACC. All right. So let's go into this and we'll knock it out. Now, next slide, fool. All right. So CAPM. All right. So capital asset pricing model. Now, the Kappa Model takes into account several factors that investors need to consider when investing in a company. The 2 ways for a company to grow are utilizing either debt or equity, okay? And what I mean by that is, how do you grow? You need money, right? Right? You have to have money. So debt is, we're talking about loans, bonds, etc., and equity being selling of public shares, right? Selling off part of the ownership of the company for a certain amount of money. And then that money is going into the company, which it better would have shown on the shareholders form there to the SEC. So these terms can be too much for some people to unpack, all right? So let's break them down a little bit, all right? So you see up there, I got cost of equity equals risk-free rate plus market risk premium times beta, right? A lot of times you'll see it written as risk-free rate plus beta times market risk premium. It doesn't really matter because you're going to do the multiplication first and then add the risk-free rate. So to me, I always wonder, why don't you just put market risk premium times beta plus risk-free rate? And I think it was because whoever came up with it was like, I just want to make someone mess up and add these two first, okay? It is what it is, right? So what is risk-free rate? It is the yield or what your return will be for a zero risk investment. Okay, that's simply what risk-free rate means. Now, can anybody tell me an investment that has zero risk?
Treasury bills.
Anyone else? No, there isn't one. Unfortunately, because no investment ever carries zero risk. Now, he is correct. In the U.S., we use government debt as a means for risk-free rates, which we mean the treasury bonds, treasury notes, treasury yields, right? Or the yields on those bonds and notes. We usually use the 10-year. Some people use the 20, so on and so on. But the 10-year is more stable. And while we say there's no risk in that, well, what happens if the United States government defaults? Do you get your money? Absolutely not. So there is potential to do that, right? So that's why there are zero risks. That's why there is no investment with zero risk. Now, if that investment was backed by something else, you can see it wasn't zero risk, but then that commodity could change prices. So how do you have a fixed sum? So there's always some type of risk because you can't get it to zero, but you know, if the country defaults your cash, nobody's cash is worth anything and the whole stock market's gone, so who cares? All right. So market risk premium. If you look in there, you'll see the big R and the little M. All right. That means the rate or the return on the market. Okay. And then the RF is, of course, your risk-free rate. All right. So it is the market risk premium is the difference between the expected return on a market portfolio and risk-free rate. So we just subtract risk-free rate from market, and that gives us our answer. Now, you see it down here. I kind of wrote it so you can see it. RM equals that. And all right. So if you ever see this written down somewhere, you say you're in a finance class, and you're trying to figure out what it means. It's just market risk premium. Because they'll usually give you market risk premium in the question, but you know, you're trying to figure out what it is. That's it right there. And it's almost always going to be next to a beta. All right, so you can get this number pretty easily. You can just Google it. All right, but I have my source. And when I mean Google it, you know, everyone here, you know, you can Google and you'll get 90 different answers, right? So sometimes you can get this number from your broker, but find that one source that is legit and use that. Beta is even more complicated, okay? We're going to talk about that one here soon too, because beta refers to the volatility related to the investment. So if the market goes up 1%, what does my stock do? So if you have a 1.2 beta, the market goes up 1%, our stock goes up 1.2. All right, so, or 1.2%. I think beta is actually the next one. Yeah, it is. So that is the formula to figure out beta, and that's not why I'm going to do it. You see BC, and the C on there just means asset C. It doesn't mean anything. It could be asset A, it could be asset B, but I just always use asset C because B, I might think it's something else because I have an old thing. So, and anytime you see M at the bottom, it's always market, okay? So, are we going to try to figure out the correlation coefficient between an asset and a market portfolio? Yeah, we're not doing that. We're going to Google it. And then you have the standard deviation of asset C divided by the standard deviation of the market portfolio. Now, I can get that from our broker because I can go in and look at the standard deviation of the S&P 500 and look at the standard deviation of the market. Now, the issue there is how long of a standard deviation do you use, right? Because if I only have a year's worth of data up on the screen, will that provide me that standard deviation? And that's where most retail value traders mess up that try to use this. And the reason why is 1 year is not a good sign, right? It's not giving me what this company is really about, because Apple doesn't release super cycles every year, right? Maybe it's every 2 years. It used to be even longer. So we need to get as wide as we can go. I normally try to go at least 4 years out, but if you could and you have the time, go 7. I don't really care, all right? And get that standard deviation. Right? And as you can see, I said I'm not even going to do it. Now, we want to know how to get this. So I'm going to show you my source really quick. And I think I already told you, it's just beta is the, I think I had on the other side. It measures the assets market's risks, right? So basically it measures the sensitivity of the asset to the market's movements. For example, if the beta is 1.2, that means if the market portfolio goes up by 1%, the value of the asset is likely to go up to 1.2. And in trading, the most recognized form of trading is called mean reversion. It doesn't matter if you're trading with trend lines, if you're trading with moving averages, or you're using some crazy curve, Fibonacci scale stuff. Guess what? It's all mean reversion, right? Regardless of what you're looking at, right? That doesn't mean it's going to work, but that's basically almost every technical analysis you're talking about in some way, form. That strategy is based upon mean reversion. All right. Did we already do that one? Okay, yeah. So cost of equity, boom. So what is the risk return rate for Apple? What is the market risk premium? And what is beta? Okay, I'm about to show y'all though. Beep. You want to know market risk premium? I use this little website right here. It's called Market Risk Premium. Pretty simple. I go in here and it basically tells me what it is. And you will notice right now, by the day, it is extremely low. You see implied return on the market. If you want to know what that is, that's RM. That is 4.83. And then you have the risk-free rate, right? That's big R, little f, 1.24%. And then you have the implied market risk premium. Basically, all they did was subtract 1.24 from 4.39, and it gave us 3.59. Historically, if I was to pull up this, I might actually even be able to do that, but you're probably not going to care to look at that. If I go to all, you will see that normally we sit a lot higher than right here. Even if you go back to December 2008 and all that growing, why is the implied market risk premium so low? Can anybody explain that? It is absolutely out of my mind. That, well, I'll tell you why. 2008 and 9, we had the markets drop out, right? So the implied return, or what they thought the implied return on the market was a 9.14, right? And the risk-free rate was 2%. Now, we can go on and on and on and on, and you'll see that, whatever, interest rates get low, but there's still a large amount. So we normally sit between 6 and 8. So if you ever take a finance class, I promise you, every market risk premium on that test is going to be 6, 7, or 8. All right. But now, if you come all the way down here, post-COVID, all right, when the United States is just buying stocks up, bonds up, everything they can get their hands on, like Fat Boy and candy, it's dropped that risk-free rate so low. Look at that, 0.72. That's absolutely crazy, 0.55. Now, I know we're not getting that, but that is what the risk-free rate was. Now, currently, I just boop all the way over here. It should be like the end of July. All right. So we're sitting at around, well, that one's wrong, but I can't get it to go over one more without going off the screen. I could probably get it by going back to the 3-month one and just scrolling down. All right, there we go. All right, so that's where we're at. Look at that market return. The expected return from where the market is here for the next year is 4.83. Now we know historically what is the average return from the market. It's about 10% because we're using nominal figures here, not real figures. That means adjusted for inflation, right? Nominal figures. And that's another thing. If you're going to use, most people are going to just use nominal figures. That means we're not adjusting for inflation. If you are going to adjust for inflation, you have to adjust everything in the whole formula for inflation or it doesn't work out, okay? So I'm not going to get into that one. Just leave it nominal, all right? You will know. It will say real and before it, okay? If it doesn't say anything, it's nominal. All right. And you can see the risk-free rate is pretty low, 1.24, but then our implied market return is only 4.83. That's garbage. That's low. So basically what they're saying, if you put right now, we only expect SPY to provide 4.83% returns. All right, that's it. When it's usually 10% or over 10%, depending on where the market's at. Basically, it's showing us that the market is likely way overvalued, but we all know that by now, right? And you can see, going back all these recessions, we're just way down here, and it's kind of been going that way for a hot minute, right? That risk-free rate. And that's because we kept rates, personally, I think we kept rates too low, right? And everybody can say, oh, it's great, we can get businesses and everything else. What are you talking about? From here, from 2009 till 2016, we grew our GDP pretty okay. It wasn't bad. But we lost income like there was no tomorrow to other countries. So all the money we gave people for free, they just used that money and outsourced it, right? The great exodus of the United States jobs were basically right after the recession. They just said, boop, done, and blew it up. All right. So, risk-free rate, I got it written down. It is 1.24. Market risk premium is 3.59. Now, what is beta for my stock? Now, this is a different question that you want to ask. You can just go Google, what is Apple's beta? Your broker should give you beta because beta is a huge risk analysis thing in trading stocks. Okay, you probably have seen it, you just didn't know what it was. I'm not going to pull it up for you, but you can Google what Apple's beta is. I can tell you it's pretty close to 1.2, all right? And I don't even need to look at it, but I can Google it real quick and find out. Beta. All right. So here we go. Beta, Apple. You want something else? Look, it'll tell you most of your stuff you're looking for. And this is a solid, macro axis is a solid, they're basically using all the information I would use to figure out beta also, but if it wasn't for the standard deviations, which require me to get variances and things like that, we would do it. Like I said, just knock this out. And you can see also market risk premium. I already got that one down there. That was the website that we were at. So let me go to the next slide. I'm reading chat right now. Sorry, ladies and gentlemen. Now, the next way is the WACC. All right, however you want to say it. I just call it the weighted average cost of capital, or the cost of capital, right? And everybody's like, what's weighted mean? That's actually the cost of capital. I'm just taking it all, right? So, it's the cost of debt and equity in terms of percentage, right? So, for instance, if 80% of my capital was raised through equity and only 20% was raised through debt, right? I basically take all my debt capital, say it cost me 5% for my debt, I take 5% and times it by 0.20, and then I take my equity, I guess, that I had 80% in, take the cost of that and times it by 0.80, get the answer, add them together, it's my weighted average cost of capital. All right. I promise you. Once again, you ever get into corporate finance, you're going to hate weighted average everything because everything's weighted average. All right. V equals E plus D. All right, man. The value equals equity plus debt. There's no difference than asset equals equity plus debt. All right. And then you're going to use some simple algebra to get E and D, cross multiplying. Okay. RE is the cost of equity, RD is the cost of debt, and TC is the corporate tax rate. Now, are we going to figure all that out? Absolutely not. All right. What we're going to do is we're going to Google it. All right. But once again, that same website that I just showed you will give you that. But for your own purposes, if you ever wanted to do it for yourself, for a business, I mean, hopefully you have someone in finance that understands this. So any project you put out, I don't care if it is, I am going to, add a new route to my paper route, all right, whatever, all right. Someone should have done this. Should have done a cost analysis to know what would you be receiving, what is this extra going to cost me, and you would need to know your weighted average cost of capital to know if adding all those other expenses would be worth it. All right. And lastly, what we want as a return. Okay. It's pretty much what it sounds like. Okay. We know how much our capital costs as smaller businesses, right? Say I own a business and I got a loan for $100 or $1 million, and it cost me, and I pay 5% a year on that loan. Okay, whatever. Say it's a floating loan, I pull out $100K every year, or I pull out $1 million every year. Right? Now, on that, 5% is what I'm going to own. I know that's super cheap, so don't hate me. So that means for me to break even, I have to make at least 5% to pay back that loan. Right? So I got to make at least $50,000 to pay back that loan every year just for the interest. Okay? Now, but I want to make 100K. That means I need 10%. I want to make 10%. Well, yes, I look at it a little bit different. I understand I have loans. I add those into my balance sheets and all that. So they should subtract it and make my cash flow equal and get rid of it. But when you're doing this and you haven't added in the loans and you're trying to figure out, hey, should I go with this floating loan or this fixed rate loan or some cool currency swap, or should I borrow money? Should I use cash or should I get a loan? I can tell you almost always, unless your credit blows, you get a loan. Throwing cash into something, unless you're making a large percentage, unless you have the best margins on the planet and no risk, you want to get the loan. Take the loan, pay the 12%, and then if you go bankrupt, you go bankrupt. I know that's bad, but it is what it is, all right? Because that cash that you didn't save, now you can invest that, make 10% a year, right? Which is not bad. And then if the business does go under, guess what they can't take away from you? Well, I guess they could. They could take away anything that, that you put up for that business. But, you have some liability, and if you can't figure out how to move that money, you need help, okay? So I can't just make 100K. I need to make 150K on that $1 million because I have to pay the 5% back for my loan and then the 100K that I want for my pocket. So my required rate of return is 15%. Now this is simplified to the max. I hope you understand that. I pay 5% someone. I want to take home 10%. I need to make 15% on this $1 million every year, or it's not worth it to me. Okay, So we can also do that. All right. Just because the discount rate is 6%, do I want to put my money into a company that's going to pay me 6% and have risk? Well, I can tell you right now, the answer is nope. All right. I know what Apple's is. It's actually quite low, actually, but it's Apple. Okay. Now, the next thing we have to do is make assumptions. How much your sales going to grow? Okay, that means revenue from each stream. Break it down. And Apple's a little bit hard because we only know services and the other stuff. So we don't know every little thing. So we know services is growing. Hardware sales, not so much. All right, it's really not. All right. And I'll show you why it's not here in a second. And then we have COGS, cost of goods. What is the cost of goods going to be? How is that working out? Right? You might think Apple's cost of goods have been going down. No, they're not. Just like anything else, they're going up. All right. Now, their margins might be improving, but they're still going up because the revenue is going up. All right. S&G and growth. All right. That is basically, let's look at that as operating costs, cost of management, things like that. Corporate tax rate. This is going to be a huge one that we're going to talk about because what's happening right now with the corporate tax rate. Anybody know what the corporate tax rate is right now? Should know because you can, if you have a business, you should definitely be paying that corporate tax rate with the maximum amount of your ability and then floating that back to you somehow. Well, it's 21%. Current administration has been talking about raising it to 28%. What does that look like? Will it be over a few years? I don't know. Okay. It used to be 31%. I'm not going to get into an economics class of where I think corporate tax rates should be for the best of the economy because most people won't like that answer. But it's actually cheaper than 21%. And that's just using statistics and probability. But it's not much. It's like 19.6. All right. Then we need to know asset percentage to revenue and liability percentage of revenue. Normally when I do this, those don't really affect anything too greatly, so I just leave them alone. I just, whatever that last year is, I just bloop across the map because it does take a lot of info on that for the assets percentage of revenue. So much assets change, liabilities change. I don't want to go in there and figure out when are these liabilities going to be up, and then I got to adjust the revenue. Just leave it the same. All right, and then finally, be realistic. At some point, growth will plateau for any amazing stock. Due to economic factors, can Apple grow at, say, 6% for the next 100 years? I don't even want to know what that math is. It's a lot. All right. Can Apple grow at 6% for the next 10 years? Anybody think they can? Let's put it like this. I think Apple is going to put up a huge number this year, right? They had 2.74 or 274 billion last year in revenues. I think it is going to be up there. All right, it's going to be possibly breaking that 300 billion revenues. Okay. Now, of course, cost of goods are going to go up probably more than they normally do. Margins are going to be impacted, but still 300 billion. Just think about how much money 300 billion is. All right. Now, if we say 6% for, say, 12 years to make it easy for me, okay? Well, we use the rule of 72. No. The worst thing, any car that Apple makes is just a brand thing. Cars lose money. All right, so, and it's definitely no car company will ever make what Apple makes. I don't care who you are. Ford is the cash king when it comes to cars. They make a lot of cash. They just give it back to their investors through dividends when they have them. I mean, they sell more cars than, shoot, anybody, right? 5,000 trucks a day. And they don't make any money. Apple sells phones and makes 1 million times their money. So I don't think the service side of it's going to be an issue. But we'll get into that here in a second on growth. So we're talking in 12 years, Apple will double its valuation and be worth $4 trillion and have $600 billion, no inflation included, in revenue. Okay. That's not a problem. In 12 more years, it's going to be 1.2 trillion. Now we have a problem. That's actually more cash than what's probably going to be in circulation. So how is that possible? It's not. So it's sooner or later, Apple's going to plateau. Now, that's without any other economic factors. Population is decreasing, by the way. If you don't know, there's only a few countries in the world that have an increase in population. Everybody's population is decreasing. Basic demand curve, what happens to demand when population decreases? Well, you lost the population, right? Now we're looking at targeted demographics, but this is Apple. So everyone is, kind of an Apple person, right? Or at least the majority of the population, or at least once one. So decrease there. You have how many billions of people out there with phones? At some point in time, you're going to stop you're going to stop selling those phones. Now, I get services, and Apple has got their services and everything going on. Services are growing. I'm going to let you know right now, phones aren't, not when it comes to cash flow. Services is what's making Apple grow. But still, it gets to a point is how much money are you willing to spend on services for Apple a year? Well, the average person with an Apple phone spends about $100 and something bucks. It's all the add-ons that you get and things like that, right? So it's just not there. You can't take 360 million phone users every year that are going to purchase something that's $100 and think you're going to use services to double your thing. That's why I say keep it realistic, right? So if you think Apple's just going to grow for 6% for the next 20 years, okay, as an investment, you're stupid. I'm just going to say that out loud. All right. There's going to be some times where it dips, and there's going to be some times where it might grow 15%, then come back down. All right. The probability that they grow for 6% for that long, who knows? Okay. Cars, I'm not worried about. Cars are garbage. Nobody cares what a car comes. You have Tesla, which I guess they started making money, but they make more money in batteries and other stuff than they actually do that. But, it is what it is. Are they going to get into it? I don't know. Probably not. You don't want me to do this for Tesla because it'll get destroyed and you'll hate me. But discounted cash flow really won't work on Tesla because it's not a stable enough stock. Apple is. Okay? So, let me move this down real quick. And we're going to go over here to income statement. And we're going to do some little work here. Or I think we're going to do some little work here. All right, so we're going to go here. Now we have products. This is net sales products, basically revenue, total net sales. So let's do this and get a percentage. Anybody know how to get an average of percentage over 4 years? Something like that. The number of years minus 1. Whoop, I messed that up. My bad. Let's adjust that. All right. F5 divided by that. I didn't put that first one in parentheses. So Over the last 4 years, Apple's products, that means phones, has only grown at an average of 2.9% a year. Regardless of what their numbers say or whatever anybody else says, it's clearly right here, products. This is what they sold. It went up, it went down, it went up again. But in the end, if I take the averages for each one of those and decreases for each one of those, and then put them to the fourth power, divide by 1, or subtract 1, it will give me the percentage. That percentage, because it would have gave me 1.29, that's wrong. It's 2.9. So we need to know that. There you go. It is simply 2.9% is the growth, okay, in their products. We don't actually even have to rewrite that, okay? So we'll copy that, put it right there. Now, services, look at that growth. It went from 32 to 53. Doesn't take the genius to know that 65.4 billion would have been 100%. So that is would have been 100% over 4 years. So that is a massive amount of increase, and that's your answer. Now, at 13.2%, that is a good number. But the problem is very simple. Services is becoming a good percentage of their actual revenue. But it's actually an extreme. People think services are cheap. Well, they are cheap once they're running, but they're extremely expensive to set up. And what I mean by that is you got server farms and things like that. So the inlay is high. And that's probably why Apple had a few, you'll look at them actually, and you'll see their gross, some of their profit went down a little bit, okay? And most likely it's because of the huge outlay investment for all these services for future stuff. So if we add these together, the total net sales from products and services has grown by 4.6 per year. All right. And that's now when they're coming out with everything new. You get what I'm saying? So the new iPhones are hitting out. No new technology. Maybe some new comes out. Might be great. It is what it is. The new watch, the computers are taking over. So Apple's killing it right now. There's no doubt. I promise you, I might hate on them here, but Apple by far is the best company out there by the books. Okay, I don't care what evaluation you use, they're ridiculous. Okay, but maybe not. But some people think, the to the moon people. All right, so 4.6 growth is great because Apple's worth $2 trillion. Well, it's market price, but it's bringing in, profit wise, 70 billion a year. So 4% growth on that is no joke. That means if we use the rule of 72 again, right? You're going to take that and say, hey, in the next almost 15 years, Apple will be printing almost $200 billion cash each year. Now, I have zero faith that they will bring in that much money in 15 years. And it's not because of Apple, because this is where people forget some stuff. All right. So now we're going to go down to cost of goods. And guess what? I can do that for this too. So you don't really have to look at that when we're looking at gross margin. So when we're looking at gross margin, that's what we really want to look at, okay? Because our cost of goods have been going up. Products have been going up higher than this one. Margins have decreased over the last 4 years. Services, of course, you see the cost of those have greatly went up. I kind of talked about that, but who cares? It's high. The growth is way higher on the services side. So we come down to gross margin. So that is really our growth, okay? It's the cash. It's 4.4 a year, regardless of whatever Apple put in their information. I just did the math. That is just that. Now, there's a little bit other difference. Now we have this little thing over here called total operating expenses, research and development, administration, that SGA I told you about, selling, general, and administration, the operating costs, is grown 9%. Well, it's grown 9%, but the gross margin's only gone up 4.4. So by saying, oh, but they went up more, well, yes, they did, because the cost of total operating cost was minuscule, right? It's $38 billion, while 4% of 274 million or billion is way more than 9% of 38. You get what I'm saying? So that's fine. But you understand, as those numbers increase over the next 15 years, that 38, if it continues to grow and all the growth stays the same, that operating expense is going to balloon. And you can't say it's not going to balloon, because if you're going to get the products and the revenue and all that stuff out, you're going to need more people to push it. So yes, it will go up. And that is the dilemma for a big company, okay? Is everybody thinks the more you make, the cheaper the products gets. Anybody that's really in that business knows that is not the case. Yes, if you buy 1,000 t-shirts, okay, those 1,000 t-shirts might cost less than buying one. But now go ask someone to build you 10 million t-shirts, or make you 10 million t-shirts, and you want them next month, and see which one's cheaper. I bet you money you can buy that one way cheaper, okay? So there comes a point where that supply is stretched, right? You have a surplus of demand rather than supply. And of course, you have your net income down here, which should be most of it, all of it, added together. And you can see, even with all that other stuff, which that's not your gross margin, it still comes out to a growth of 4.4. I already knew the answer because I did an evaluation for investment bank earlier this year on Apple. All right. So, and you can also see right here your earnings per share. Back in the day, you used to get about $9 a year. Now you're getting about that, which, whatever you're saying, it's not the best return on your investment if I look at it. But the problem is, it might not be the best one of these years. It's still better than all the other stocks in the market. That's the problem. The bonds are so cheap, everything's so high price, and Apple's about the only one that really is even close to being the correct number. Now, other things you can look for is you can look for cash and cash equivalents, and all the way down here. I know I don't have total assets down here. If you want to know how much cash someone has, you want to look for, I'm going to highlight them for you. How about that? Just so you can track and understand where cash comes from. Marketable securities is cash. Accounts receivables is not cash, but it could be. It's the easiest way to say it. I hate to say it. It's money they haven't received yet. Okay. Now you come down here to non-current assets, and you have market securities right there, long terms. Okay, so you add those to that also. Okay, because those are basically cash marketable securities. Normally, they're going to be in a form of some note or some long-term thing they did to secure. With a company like Apple, I would expect that to be some type of inflation at stuff. All right, some inflation bond. All right, and don't worry about. So that is about their liquidity total. But right now, this is what's going to show up in their books. Okay, just that. All right, as current assets. But this is really what they got. All right, and then you'll see down here liabilities. So where you see that cool stuff that says, accounts receivable, that means money that's owes to you. You also see where it says accounts payable, and it's $42 billion. So, they owe some money, right? And of course, they'll sell bonds to pay for it. They're not going to use their cash because they're not stupid, right? So you can come down here and actually see what the total liabilities and shareholders' equity is, and you can see how that's working. And you will likely, let me see where that was. Let me I copied it to put it over here. And let's go down here, and I think it was that one. Yeah. All right. Boop. And that is going to be wrong because we don't have 4 years on this one. I only put 3 in there. So we got to change that to a third. Get rid of that reference. And then boom. All right. So total liabilities is, it's not as bad as we think because it's actually growing slower than our total margin, which is what we kind of want because we don't really care about liabilities. We care about cash. All right. And this is the same that we can come in here and do the same thing for here to see what our cash is, but beginning cash and all that doesn't really make a difference. We have this information in our income statement. But depreciation, maybe. If you see a sharp break off in depreciation, it could be they built a bunch of stuff a long time ago and now their depreciation is running out. Okay, that means the buildings are no longer capable of depreciating. But Apple will revamp those anyways, all right? All right, if you want to see from operating activities, you can see that all the way down. Investing activities, how well are they doing? Investing activities, sales from proceeds of March, all that stuff's going to be in there. All right, and financial acts, you can basically see it. How much money they make from issuing stock, payments and taxes, repurchases of common stock, which is, I like that they actually write this as repurchases of common stock. If you ever see one that says treasury stock, that means they purchased them back, okay? But it's just something they like to confuse my students with by calling them treasury stocks. Just repurchases stocks. Thank you so much, Apple. Okay, so let's go over here and make some assumptions. And let me see what I need to do this at. Okay, that will semi work. Let me see what I got over here. All right, so we'll just no. Let me put that back up. I got monitors, and the one I have on right now is actually my computer screen. We're just gonna leave it on that one, okay? Where you at? Excel. So let's go in here and look at some stuff. All these are inputted in normally. I have revenues. All these right here will be automatically calculated. So in 2021, I think the growth of revenue will dramatically increase. Okay, I do. I really do think it will increase. So if you look on here, I'm using J22, which is this one right here, and then I'm adding something else to it. You can just type it in, but down here I'll write it in here so I can easily change it without changing the formula. I think it'll probably go up by about 1.5. Okay, I really do. So I'm giving them a 7% increase at minimum. Okay, and remember, it might go up by 15%, but in 2019 it went down by 2. And if we want to really go back and look, there was about 4 more years in this decade that it was negative. So it happens. Even though it was growing like crazy, it lost money. All right. Or its cash flow was negative. That means they're just, sending money. Oh, and that other $100,000 that was in non-current securities, you know what I think that is? Overseas money. That's why it's not current. That's what I put in my asset or in my last thing. So after that, where do I think it will go? Do I think it will hold 7.5? I do think it will hold 7.5. I think it can. I think 2021 will be a good year. 2022 will be a good year. Now, what about 2022? I don't know. Or 23. Look, I can't. I don't think it'll be 8%. There's just, it's too much money to grow. I mean, there's just not that many more customers. And everybody can go, oh, but they're going to have Apple and they're going to have this. You don't understand growth. Because how many iPhones do you buy a year? Just answer that question. 1? Maybe 1 every 2 years? What's your average? You can talk or you can type it. I'm waiting.
About one a year.
So say you use one a year, and probably $1,000. Margins are great on those things. So let's just say they make $400 off of you. Okay. Now you get services. Well, guess what? Services have good margins, but they're still not great margins either. Or they're great margins compared to everyone else, but they're no better than Apple's margins. So how much would you pay if you paid? I'll actually answer this. You got 12 months. I don't know how much Apple pays for crap. I have no idea. Say Apple TV. Say you got that. Let's just say it's $9.99. All right, $119. Okay. Now let's say that you purchase a bunch of stuff on. You spend $1,000 on. That's a lot. Who spends $1,000 on that? Maybe you spend. Average person spends $200 on in-app purchases. Okay, so we'll type that in 200, but they don't get all of that. They only get 15%. We'll just say that. So they get that. Now, what else service do you want to add in there? 4 per year. Well, I'm doing per person. All right. We'll just say, hey, Apple somehow can get you an extra $100. Okay, great. So here we go. Bring it down. We'll automatic sum it whenever I find my sum. Now we're going to take that number, and I can pull up the services number margins. It's over there in the book. But now I'm going to take that number and times it by the margin rate. So after, oh crap, it was like $74. All right. So Apple is making $74 off of every person that has an iPhone, basically. Let's just say that's it. That's it. I mean, what are you going to increase it in, right? To increase that service, you're going to have to sell more hardware, things like that, right? So the hardware is the bigger growth thing. So, but if they sell one iPhone, they're making $400 off of you. So you get what I'm saying? The services is growing now, but it will plateau. It will plateau at a point also. It just will not continue to go up. And it's not that I don't think Apple could come up with the services. What do you think Apple's going to run into? I just typed it on my screen. That's right. Regulation. Do y'all not Karens? That's 100%. What do you think is going to happen everybody hates Apple now, and yes, they make a lot of stuff overseas, but it's an American company. It does hoard its cash off to the outside. We got that. But it's still an American company, right? If Apple doesn't make money, then Samsung's going to make money, right? That's the only really real competitor. And then America wouldn't make any more money anyways, right? We just lose more revenue. But the government doesn't think about that. They think Apple is a monopoly. Well, Apple's not even near a monopoly. Apple's not even one of the top 2 phone manufacturers in the world. They're not. Sorry, Samsung and China HN. So how are they a monopoly if they only control about 18-19% of the market? You can't be a monopoly with 18% of the market. You can't even be a duopoly because you're not even number 1 or 2. You're 3, right? So can Apple steal away from those Samsung bases? Absolutely not. I'm sorry. If you think Apple is a premium product, it is not. Apple cannot sell a phone for $150, $60. It's just not worth their time because it would just ruin the whole supply and demand, or the supply side of the house for them. Now, what will happen where I think will happen if they do get into crap, too much stuff, is they're going to break them up. I mean, AT&T got broke up, right? Because they were worth too much. You don't think that's going to happen today with all these comrades that think socialism and all this other craziness is how it should be, and they're not going to go after the number one big company? They are. That doesn't mean they're going to break them up, but they're going to limit which markets they can get into to break them, to slow them down, right? That's what I'm getting at, is if services gets too crazy, and then hardware can't go too much crazy because they basically 80% of Americans got something Apple in their hand right now or near them. So only way is expand overseas, and that's the problem because Americans live in excess while the rest of the world really doesn't. Very few other countries do. I mean, you can even look at a company like France, right? Everybody thinks France is all, well, do I have any people in here from French or from France that are French? Because if we do, I'm going to explain how crazy America is to you if you don't know. All right? Put it like this. If you receive food stamps, if you receive welfare in the United States, it means you're in poverty. You actually make more money than the average French citizen does. Can you explain that? That's right. Poverty basically means, well, depending on whose definition, 50 or 40% of the mean average of the total population income. That means basically if America's mean is $60,000, you take 40% or 50%, depending on who you use, and that is anything below that's poverty. Right? And they all will receive welfare in some shape, way, or form. Sometimes it's by state. That's higher than the average income in France. I'm just saying. It's crazy. And do French people live worse than us? Absolutely not. They don't. Most of them live much better lives than us. It's because we spend money on stupid stuff. All right? We buy iPhones that we can't afford. We buy everything that we can't afford. Hey, I got a job working at McDonald's. I'm making $8 an hour. Now I'm making $12 because of labor shortages. And I need some earplugs for my $1,200 phone. What do? I go out and buy $400 Apple Pro pods or something instead of the $12 Bluetooth ones because I'm American. Okay? It's just how it goes. So expanding overseas is socially hard. Okay? Now you're going to get the rich people that want the keeping up with the Joneses. They want the premium product. But to hit the masses, it's never going to happen. Not like that. All right? But I think the number one threat is regulations and taxes. And we're going to get to the taxes. So after that, I'm going to give them growth for a few years to get to 8%. And then I'm going to start knocking them down. And that doesn't mean I think they're going to go down. I think they're just not going to grow as much. All right. Where's my growth at? Because growing at that rate is just ridiculous. So we'll go back to their standard growth rate, which we already know is what? 4.4, by the way, if you don't remember it. So before you argue with me, just know that they've only grown 4.4% over the last so many years. All right. And then we can just zero these out. And we'll use that as its average, 4.5, which is a blip higher. All right. Now what we got to do also is go up here and estimate the tax rate. It's at 21 right now, so we'll leave it at 21. Do you think the tax rate will go up or down? And what this is going to affect is the total working capital, hence cash flow. Okay. Let's just say we'll slowly increase it to, say it goes to 23, 25, 28, and then we'll leave it at 28. So we'll walk it up. All right. Now we have Biden, 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 some Republican, some Republican, some Republican. So who knows? It might go down, but I think 28 is a fair assumption because it is what it is. Now you have this right here, this growth rate over a certain amount of time. You know, it's basically it's a percentage of sales, right? So it's in here and it's cool, but it's gone down. All right. I don't think that sales and goods and administration will go down for Apple, but I'm going to give them the benefit of doubt because they do have one of the better management. Well, they got one of the best management systems on the planet. Now, cost of goods. This is what trips me out. Is they have cost of goods going down pre-stock on this. I don't think cost of goods are going down. I think cost of goods are going to go up. Because sooner or later they're just going to be out of the price range and just be ridiculous, right? People buy iPhones because they're semi-affordable and, you know, they can afford them, I guess you could say. They don't buy them because they're Louis Vuitton phones, you know. So I think that will be an increase rather than a decrease. It's a very small percentage, but I'm just going to knock that one out and then average it down. All right. Now we got our tax rate up. We got that up. We got our cost of goods about right. Changed our administration. Our cost of goods percentage, that means we're going to be rocking about 40% margins. Minus that will be 26% margins. I can live with that. I can leave it there. I can do that. I think that's solid. Like I said, I don't really touch those. All right, so now let's come down here and look at this. Now we're at our weighted cost of capital. If you want to know what Apple's legit weighted average cost of capital is, because of course I did this analysis and then I added all the new stuff they did and plus purchasing of stocks, reselling of stocks. I updated today. It is like within a small. It's like 8.66669999994823 or something like that. All right, so 8.7 is its weighted average cost of capital. So right now they spend on an average 8.7%, and you're probably like, that's a lot. Well, you got to think is they're paying dividends. They have bonds, but they've actually lowered that. It used to be higher with all these billions they spent. That's what kind of helped them out, and it brought it down there. And by the way, 8.7% is extremely low cost of capital. I'm just letting you know, okay? Especially for a company that has hundreds of billions of dollars, all right, and loans. So your net free cash flow, all right, present value of that, of all of it, is about 435 billion over this period of time. It means if I add up what they're going to make in the next almost 10 years, it's actually less than 10 years, right? So 21 through that, blah, blah. It basically comes out to that. And then it's actually 8 years. And then I have my terminal growth rate. So what do I think legit, honest growth rate that's terminal? Okay, well, that means it will grow forever and ever and ever and ever. 5% is too high. I'm just telling you right now. These are fractions of percentages. At 5%, it says that the terminal equity value of this stock is $1.6 trillion. Okay? It's just what it says. Don't hate on me. Okay? And we all know that Apple is inflated for multiple reasons. One, Apple just bought back like $50 billion in stocks this year, and the government's been buying it too. So it is what it is. All right. But once again, it's the only one that's even near its current value, near its evaluation. So let's just say that it's going to be 3, and watch how sensitive it is to this terminal growth rate, which we talked about is one of the biggest issues. It goes down dramatically, right? That was a huge hit. That was a 25% hit on it. Now, its cost of capital, I think will go down this year, mainly because of all the debt that paid off from all this, and they didn't have to restructure debt, and they're going more into using their working capital to pay off everything, and the only thing they really use for what they take on debt for is paying dividends and buying back shares. Actually, okay, so that's fine because they're using debt to remove, older debt, I guess you can say, and provide investors. So I actually think it's actually going to go down to right about that. So now, how can I adjust for that? Terminal, right? So I don't know. I would say somewhere around 7 to 6.6, I think, is where it will end up. So they're very close to being worth, $2 trillion, almost $1.9 trillion. Now, if I was to do this for any other company and just say they were a $2 trillion company like Apple, I can promise you it wouldn't even be a trillion. It would be like 600 million or 600 billion. There's no one with the cash flows that can even get close to actually near their evaluation right now. So you'll see this little opportunity growth calculator over there. So what should I purchase this for? Okay, it is what it is. You go down here and you see at 3% with a weighted average cost of, I'm going to put 5 in there, which I don't think it'd ever get to 5. But if the rate was that, you'll see at 5 and almost 7 is that. If I was to say a 6% weighted average cost, it's that. But this is how the company should run, right? So the question is I want to make a certain percentage on Apple each year, either through buybacks, dividends, or selling some of my shares off. I want to make an average of a certain percentage. What percentage do you want to make? I'm not options, I'm talking about investing. Okay? What do you want to make each year? You've got to have it. What's your required rate of return? You can talk. I'm going to unmute people. Or you can just type it in there. What percentage? When you invest in something, what are you hoping to actually make each year? And I know some of y'all are going to write some ridiculous numbers. How about this? If this is me only making 6.6%, right? That's basically what it's saying. It's marked, then I'm putting its value at this. And basically I take its equity value, divide it by the number of shares, and that will give me the price I should pay for the stock. 10 to 15%. Well, since the stock market provides 10% nominal, 7% real each year, I would say I want to beat the stock market. I'm just saying. I want to beat SPY. Okay? Now, once again, the rest of the stocks are way worse than this. But let's just say we'll break that in half and put, we want to make 10%. We'll go at the bottom of Edwards, the top of budget. We'll put 10 down. Watch what happens to the equity value of this share. And if you're saying you want to make 10% on this stock and not using any other methods, and by the way, I understand you're going to be pissed at this number, all you Apple lovers. The fact is, this will be true. Most likely, I would bet on it over a long period of time. I'm not talking about next year. I'm not talking about 2 years. I'm talking about 6 or 7. Here it comes. Watch how ugly this gets. 988 billion is its current value to you. And what I mean is that's not what it's worth. That means if you want to make 10% based upon the cash flow of Apple, okay? That means where will Apple be in forever? To make 10% forever on Apple, you would have to purchase it at, well, I can do the math, I guess. Here, let me do that math. What's that? Million, billion. All right, that's a lot. And there's what about? Here, I'll just do this. I should buy the shares at $58.90. Sorry. Am I going to be able to purchase that? Absolutely not. That is absolutely crazy. But I'm just telling you, that is how crazy the stock market is. Now, do I ever think you're ever going to get that? I don't. I honestly don't. But I'm just saying that is basically what it is. So you got to come back down to realize that 10% is a little crazy. So back it down to 8%, and now you're sitting at, a little bit better evaluation, putting that up to about $80, $90. Now, if there's a crash, if there's ever a crash, regardless of how crazy it gets, that 58 billion right there, I'm not saying it would stay stable. It could dip a little bit below it, but if there was capital out there, they would purchase it because it's Apple. All right, so that's safe. Everybody else can go bankrupt. Apple will never go below that number, whatever that NPV is. All right. Now, it doesn't matter. Buybacks and splits, it's cash flow. I don't care what else they do. It's cash flow. Buybacks, you buy stuff back, same fucking cash flow. You get what I'm saying? So it doesn't matter what happens to the stocks. I'm talking about currently right now, the market value of it. On that would be what the net present value is, which is that one right there at 8% with a 3% terminal growth. Now, you can say it's going to grow more, and that doesn't mean that it's not worth more right now. And that is the problem with the direct cash flow model is it is for a long-term growth. So we're not talking about buying options this year or buying stock and holding it and selling it next year, this year, or even 3 or 4 years. This is I'm buying shares and holding it for my retirement. Okay? That is what you're looking for here. You are, straight purchasing this like Warren Buffett. And then someone's going to say, well, Warren Buffett bought Apple. He sure did. But guess what he didn't buy it at? He didn't buy it at this price. He bought it when its return was... Let's go back and look at that balance sheet when I did the math. All right. When he started purchasing it, he was getting a 9.27 per share, which now it's only worth 3.3. So basically, what's the price at right now? Anybody know? Let's just say it's 150 to make it easy on me. All right. And now I'm saying it's worth somewhere around $60. Guess what? He basically bought Apple. And if we go back and look at the cash flows were good those years. It was massive growth in revenue, massive growth in everything. 2019 was the bad year. So these years where he was picking them up, they were growing even better than they are right now. And he picked them up for basically, with the split and everything, regardless how you look at it, for about $58 to $60 a share. And that's with all the splits and everything like that, all right? Because I know he paid more than that. But with the massive buybacks and the dividend pushback, his actual, what we call, when he purchased it, it was at that price, or very close to that price. So, yeah. So don't go, Warren Buffett bought it, now I'm going to buy it. You're buying it 3 times higher than he did, and he's a value investor. So the problem is why didn't you buy the stock when he bought it, not now? And he's not going to sell it. Like, stupid. He's going to hold on to that for a while, because guess what? There's nowhere else to put your money. Apple is the U.S. Treasury. So much so that Apple was within like 3 pips, which is like a fraction of a percent of the risk-free rate. That's right. The bond market basically said Apple was almost as safe as the U.S. Treasury note, 10-year note. Can you? How is that even possible? How? It makes zero sense that you just said a company is as safe as the United States government. It's ran better than the United States government. I could tell you that one. But that's how good the company is. No one else is getting bond rates and has the bond rating that Apple has. It is, it would be like the United States government collecting $18 trillion a year in taxes. You know what I'm saying? Which they don't. But it would be like having that much, because that's really what we're doing. Because Apple has debt. It has hundreds of billions of debt, but it also has hundreds of billions in cash. And it makes 70, 80 billion. Looking at this cash flow, which, and like I said, one small adjustment here. You can see right here, this one went up 15%. This one went down 2%, So what do we do? Do they stay there? Do they go down? Do they go up? I don't know. So you have to understand this is just based upon our assumptions. And like I said, this growth rate is what really destroys the valuation of it. But Apple has a solid foundation. It's going to put up somewhere around 4% to 5% in growth over a long period of time every year. If we average them out. That has been pretty much the thing since the iPhone came out. It hasn't changed. It's been in between that 4.1 and that 4.8 mark over any 5-year period. So normally you might see this one and you might say, hey, they lost money or it went down on this one. Well, did it really? It went down, right? But it was COVID. So what do we do with that, right? But then you might look at something else and say, well, in this year, it didn't do much better. Well, it did. Cost of goods went up. Gross profits went up. Net income was decent. It is what it is. And even 2020 was lower than 2018. And it just went up from 2019. But then we go back and we look at this free cash flow that was 38. Now we're gonna be double that this year, okay? I promise. So it is what it is. A lot of stuff to enter in there, and you can go play with this. I'll put up this Excel spreadsheet, and it just teaches you how to evaluate companies based upon a direct cash flow method. Now, like anything, we want to compare this with Apple with other stocks in their sector, which is kind of hard for Apple, but you get what I'm saying. And the problem is if you were to do this and you were to be unbiased, it would be, and then also if you wanted to know what that equity was, the return on your equity or the rate of return, it's 8%, right? But you have to buy it at that. So there is a way for me to tell you exactly what your return on your dollar would be based upon our formula. But I challenge you to go figure it out. It's everything you need to know is right there. Equity value, weighted average cost of capital, and you can do some little math ninja and you can get that. But NPV is extremely important. So if you're in finance, you know what it is. You do it every day. You sit here and you just type in NPV, and you're sitting there just like this all day long. You're like, all right, I'm going to, my rate of return, and I'm going to tell you right now that most businesses are going to want a 13% rate of return. And then we're going to type in our cash flow. Or you're going to be doing some 5 keys thing that's going to look something like this. Present value. Same thing. All right. That's the same way you get your, if you don't know how to use this, you can get this you want to solve for present value. So say you're buying a car and they're going to charge you a point, I don't know what people get charged. Just say they're going to charge you 2%. I don't know. and it's a 60-month loan, right? Payments are going to be $650, right? And then future value is going to be 0. That tells you how much that car's worth. That's it. That's how simple it is. That should be the sticker price, invoice price on your car. That or they're taking some money out of your pocket. Yes, car finance people don't like me at all. Because I'll structure a different loan while I'm there with someone else. It's Apple. So Apple is Apple. There's nothing as stable as Apple. I mean, it is what it is. Now, where will the price go? I don't know. But over time, it does that mean it's going to go down? I don't know if Apple's price will go down dramatically, because that number will change as time goes on. All right, so it will go up. Next year it'll be a little bit higher, and the next year it'll be a little bit higher, right? So Apple could plateau and just move up and down a little bit in the stock price and just stay in like a semi-up line, but no dramatic movement, maybe like 4% a year. And I don't think that happened this year. Maybe in a couple years it could just slowly, move up, maybe a little bit of dips in the here and there. I think in about 5 years, Apple will have a diminishing return on the market, which means in 5 years, do I think Apple will outperform the market? I actually do, but the textbook answer is no, it shouldn't. The reason why is I just don't think there's any other companies out there that can compete. Apple's just too big. I think over time, those other companies will grow bigger. Amazon can and the problem is if there's not regulations at all, there's no regulations, and it's a free market, and the government allows every company to do whatever they want. Apple will be out of business within 3 or 4 years if there's no regulations, and every company could just do whatever they want, because Amazon would shut them down. Apple couldn't compete. It's not Apple's fault. They're not even in the same sector. But the problem is Amazon is not a website or a retail company. They're not a services company. They're not a video company. Amazon is in the business of logistics. And Amazon's largest customer is just Amazon. So basically, in 4 or 5 years, you won't be able to sell an iPhone without it being through Amazon. And I don't mean on the website. That means it's somehow, shape, way, or form got here on an Amazon boat, train, plane, or something like that. It would be completely owned by Amazon if there was no regulations. They would just bury everyone. And then they could... And once they have that, they can control AWS and wipe everybody else out. It's unfair. It really is. But they can't do that because, they won't be able to. But they've gotten that big, and it's once again, it's not about Amazon.com. It's about the logistics. And if you own a business right now and you sell products, you already know that Amazon is likely cheaper for you to use their fulfillment centers to hold your products and sell to your clients than it is for you to hold them and sell direct to consumer. How is that possible? Because they're that big. Their economies of scope and scale are just out of this world. They own everything. Like, you have no idea how many planes they got, and it doesn't matter. They own everything. And most Amazon shipments are actually through the United States Postal Service. So but now in certain areas, Amazon delivers them. What happens when Amazon increases that and goes into everything? Post office is out of business. Now they control everything, all mail. Nobody will be able to compete with them. Yeah, I just don't think that will happen, and it's because it's not like any economist can't see it coming. We understand logistics wins wars, right? And logistics wins battles. That's why Apple's grown to be such a good company. Their branding was good, but Samsung sells more phones, right? They do. Even there's other phone companies that sell more phones. The problem is they don't have the logistics behind them. Apple does. And Apple, boom, takes advantage of it. But the problem is, if you think Apple's good at logistics, Amazon is logistics. And what I mean by that, the definition of logistics. Amazon wants to put you out of business, and there's no law, you're out of business. Zero. No one could compete with them. Amazon could literally put out an electric company out of business. I don't know how, but they could do it. That's how strong their logistical framework is. It's to the point where it is a national. It is a national security issue, 100%. I promise you, people talk about it all the time. You can't do anything to it. So, like I said, I understand this is a little bit crazy, and I don't really I like to teach the math, and that gets a little bit more stressed for individuals. So I didn't want to do a little promo to talk about math, but I think you'll find out that's just who I am. I'm not going to give you the answer to any test or anything like that. I do have a class that starts this Thursday, and it is a technical analysis class that we trade with the sauce and everything like that. And it's what I use. Zero fundamentals, by the way. No math. I basically provide you with everything you need to put into your system, but it still comes down to probability and thinking a little bit different. So it's the plan, the action behind it. I can tell you what all the moving averages and everything I use are, and even tell you when to buy and sell it based upon just a few things, and you'll go out and lose money because you don't know the system behind it. And even then, sometimes it's wrong, all right? Because if you find someone that says they're right 90% of the time, and they're making baggers 90% of the time, run away. Because they're not, or they'd be a trillionaire. So if you do have any questions about if you're interested in that, you can hit me up at Greg at OptionPlayers, or hit up Steve at OptionPlayers.com, or hit him up in the chat. And especially if you're not a lifer and you are an OP member, with that right there, you can hit him with that. I don't know the details behind that. I'll let Steve talk to you about that. But not only would you get my class for free, if you wanted some other classes, he usually works those in there also. He'll probably give you some. And then if you're not an OP member, where you at, right? So we got free month trial. Contact Steve or go to the website. We got a new website coming out, so I don't know exactly how that's working with the changes. So I don't know what Steve exactly wants to do with that one. So just contact Steve at Steve at OptionPlayers, or you can contact me at Greg at OptionPlayers, or you can just put it in the chat and say, hey, email me, and throw down your email, and we'll reach out to you. And basically, you're going to get a free month. If you don't like it, whatever, you can go away, and then we'll make fun of you when you do. That's just what we do. Like I said, it's we want you to do good, and we get, if you lose, we lose. It's not one of those places that we pump stuff, because I'm never going to really, I'm going to tell you what I'm trading before I trade it, and then I'm not going to tell you like, hey, you should buy it at this price. You know, it is what it is. And most of the time, we give advice, and it's more broad, and we're not even trading it, or because we're already in something else, because we do have a limited amount of capital. We don't have billions of dollars to throw around, and they're options, so you don't need a lot of money to trade options. You just need to be smart with it. And I don't know about Steve, but I teach probably a few at best classes a year, and like long classes, and I still get emails every week, like crazy amount of emails, and I know which ones took my class because they email me and they talk to me, they ask me questions, and then I know the ones that took my class but didn't pay attention to jack shit, okay? Because the other ones are like, I made this play and I lost this money. Okay, first off, that's not my strategy. I don't know what you're talking about. Why are you emailing me? But can you make back 80% of what you had 10,000 and you lost 8,000? Can you make it back by the end of the year? Well, you can. Are you? Absolutely not. And it's not because you couldn't. It's because how the hell did you lose $8,000? Because you had to lose like 50 trades in a row if you were following any of our systems to lose 80% of your portfolio, right? So it's the problem with being successful, right? You do something so often, you keep doing it, you keep doing it, you keep doing it, and then you forget about the risks. So that $500 you used to put in, you said, let me put 5,000 into it, and that was just, and then maybe you even won that one, and then you're like, oh, I'm going to put 10,000 in it now, and that's the one you lose. I'm telling you, the market will get you, and when you trade smaller amounts, market doesn't care. Okay, I can tell you right now, my algorithm sells and buys in small increments because I've already figured out if I sell large increments, I get screwed. I get slammed immediately. The market makers see my orders coming in for massive amount of controlling power, and they just manipulate it. So make sure that stays good. Yeah, Vinny, it's OP is where it's at on that sense. All right, well, I'm not going to hold anybody else up here. Like I said, hit up Steve or I on that right there. And if you have questions about discounted flow valuation, you can always ask me. It's all over the internet, I'm pretty sure. But a lot of people just don't know how to use it and get that cash flow info. And the problem is you need the income statement, the balance sheet, and the statement of cash flows. You need all three of them to actually use the DCF evaluation. But if you could just get cash flow, we can work out everything else, I guess, in the long term. You can guesstimate that. All right, I just got to find that thing right there. No problem there, West.